Nishant and I'm a partner at Finsec Law Advisors. Today, we bring to you a very new series, Finsec Case Files. This series looks at turning complex regulatory orders into simple gripping stories which you can understand and see what the regulators have done over the years. Our first story begins in the 1990s. It was a time which was a time of schemes of a quick buck, land investment schemes, plantation schemes, bond schemes. Everywhere people are trying to make quick money. Long-term returns, long-term high returns, this was the name of the game. At this time was an entrant into the market, Pearl Agro Corporation Limited or PACL. PACL promised its investors long-term high returns and land, two of the dream names which an Indian investor can ever look at. So, how did this convert into the longest running regulatory drama which has gone on for so many years and till today has not been completed? Let's look at the history. First, let's go back to 1997. At this time, the Government of India issued two press releases, notifications that clarified that any scheme selling plantation bonds, agro bonds, or any land-linked installment schemes would be classified as a collective investment scheme and needed a registration with the regulator. Then, in 1999, it was notified that a specific regulation called the Collective Investment Schemes Regulation would have come out, which SEBI notified in 1999 as well, which means any schemes which had the following four nature points would be classified as a CIS and had to be registered with SEBI. What were these 4 points? First, there should be a pooling of funds by the scheme. Second, there should be an expectation of returns from the scheme, which means people are collecting money and they are offering you a percentage return. Third, the management of such a scheme would be done by a professional manager on behalf of the investors. And fourth, that the day-to-day operations of such a scheme would not be handled by the investors at all and would be completely done by the management. If any scheme satisfied these 4 criteria, they would be considered a collective investment scheme and had to be registered with SEBI under these regulations. PACL entered the picture as a company offering land-linked installment schemes. Here's how their model worked. Interested individuals could enroll with PACL by paying some money, either in lump sum or through multiple installments over time. In return, PACL promised them high returns and that against that money, several plots of agricultural or other land would be allotted to them. Which means, over time, as the land value rose, the investors were led to expect that their investment would appreciate. That is, the value of the allotted land would be significantly higher than what they had paid. For many investors, the appeal for this was obvious. A chance to become landowners, which is a dream for every Indian family. And with small monthly investments, which means they didn't have to save for a long time and give a big lump sum to buy this land. Given the widespread reach of the agents and the aggressive marketing tactics which PACL employed, they collected large amounts of money from public over the years. The approximate is that they have collected around 49,000 crore rupees over a span of the last 10 to 20 years. However, the regulators began questioning whether PACL actually held this land which they promised the investors that they would be purchasing against their money, or whether the promises of the land allotment and returns were realistic or not. If not, this might not be a genuine sale of land and effectively a pooled investment vehicle with return expectations, which is, under SEBI's terms, a CIS. As PACL continued its scheme, SEBI initiated regulatory action. By 1998, SEBI had communicated to PACL directly that they feel that the scheme is in violation of the collective investment press releases which were issued in 1997, and this was pre the collective investment scheme regulations, and they asked them to stop these schemes. PACL, however, took a view which was contrary, saying that they were a simple purchase of land scheme and did not have any pooled investment schemes, and they continued doing their business. Then the change which happened, as we had discussed, in 1999, the CIS regulations came into the picture. After the regulations came into the picture, SEBI again jumped into action, and in 2002, they issued a formal order. This order concluded that PACL schemes, despite their presentation as a pure land sale investment plan, legally qualified as an investment scheme or a collective investment scheme under the CIS regulations, because they maintained that the 4 primary objectives were being met. PACL was collecting money from a large number of investors, which is pooling of money. PACL was being managed by a bunch of experts and not the investors directly. PACL's investors were not involved in the day-to-day affairs of the scheme itself, and a high return was being promised to the investors in return for the investment they were making. The four key criteria were directly met, and hence SEBI took a conclusion that this is a collective investment scheme, and PACL was immediately asked to stop all its schemes in all areas of India. PACL, of course, challenged this decision in court, and multiple high courts had a bunch of cases filed against this scheme. However, we are going to focus on two major high courts and their orders because they were very opposite in nature. So first, let's look at what the Rajasthan High Court said. The Rajasthan High Court had a litigation where PACL had appealed against the SEBI order, and it was stated that this is not a collective investment scheme and that PACL can continue utilizing and conducting its schemes as it has always done. However, the Delhi High Court had a public interest litigation against a bunch of such schemes under which PACL was also tagged, and Delhi High Court held that they are not concluding on whether the scheme is a collective investment scheme or not. They did, however, issue some things and some directions as to how such schemes should function ideally, and asked SEBI to look at this order again. Because of these divergent decisions, one High Court giving directives but not passing a final order, and the other giving a clear ruling in favor of PACL, a situation of legal inconsistency emerged. Given this conflict, investors, regulators, and courts recognized that a final authoritative determination of whether the schemes run by PACL are legitimate and under a collective investment scheme or not have to be determined by a higher authority. At this point in time, SEBI appealed to the Supreme Court in 2013. In 2013, the Supreme Court reviewed the conflicting High Court decisions. It ruled that the Rajasthan Court's judgment could not be stated as a final verdict on the CIS question because the earlier proceedings had not allowed a full and complete investigation. The court, in fact, then directed SEBI to conduct a fresh investigation, issue a fresh show cause notice, and conduct a thorough investigation of the schemes. They have to allow PACL to submit all documents, proofs, records, and explanations, and only then pass a fresh decision based on all these actions without considering or having bias in relation to the earlier proceedings to the case. In other words, a clean slate. The Supreme Court basically asked SEBI to do its investigation again completely and not hold any bias basis past investigations. Next, SEBI conducted this investigation as per the order of the Supreme Court. And in 2014, the final conclusive landmark judgment of SEBI came into picture. After a detailed examination, in August 2014, SEBI issued the final order which concluded that PACL schemes had satisfied all the four statutory and regulatory components of a collective investment scheme under the SEBI Act, and hence its promoters and directors were directed to stop launching or operating any such schemes. And most importantly, they had to refund all the amounts collected from the investors under these schemes, a total which amounts to approximately 49,000 crores. This order laid the direct foundation for all subsequent refund and asset liquidation. PACL took one final step. They appealed to the Securities Appellate Tribunal against the SEBI order. However, the tribunal also upheld the investigation findings of SEBI. Now, despite the 2014 order, the refunds did not happen immediately as envisaged by SEBI. There were multiple practical difficulties. The scale was enormous. It's 49,000 crores to be refunded. There were tens of millions of investors with many small investments across India. Many investors lacked the proper documentation. They had incomplete certificates. PACL had issued only certain receipts all the time, which were technically, as per them, supposed to be valid in case the company went under, but were nothing but a simple receipt and did not advocate ownership of any property they had ever sold. The verification of the claims which the investors had given and ensuring legitimate payouts was extremely difficult. Liquidation of the assets had to be done in a transparent manner. Because of these complexities and to safeguard investor interests, the Supreme Court had to intervene, and in 2016 they formed the Justice R.M. Lodha Committee to look after the management and sale of PACL's assets, to verify the claims and to oversee the refunds. Thus began what would become one of the largest investor refund exercise in India's regulatory history. Let's talk about the refund process. Under the Lodha Committee's supervision, a dedicated web portal was launched for investors to submit claim applications. The refunds have also started being processed in phase-wise, often based on the slabs of the claim of the investors themselves. Example, so small investors began first, claims of 5,000 rupees, 10,000 rupees and such. Asset liquidation involved sale of properties, land parcels, vehicles and even recovery of overseas assets, including funds repatriated from foreign jurisdictions. In fact, the Lola Committee also had a sale of some Australian assets of the company to ensure that some money is returned, and that was worth around 11,300 crores. So what has been refunded so far? As of 31st December 2019, the first refund wave had been completed, which had around 1,89,000 applications. And to the latest in 2021, roughly around 12.7 lakh claims and applications had been processed, which means around 435 crores have been refunded. That's 435 crores out of 49,000 crores. In between, the Enforcement Directorate and the SEBI also got involved and arrested the promoters of the company. And as per the update of October 31st, 2025 under the website, the committee has effected refunds of up to 1,333 crores. Because of the number of investors and the claims being in crores, number of properties to be liquidated and the ongoing claim verifications, the refund process is still ongoing and has not yet been completed. This case was a landmark for investor protection. It was also a landmark as because of these and other such schemes, the collective investment scheme regulations came into the picture in the first place. The history of PACL is not just about one company. It highlights how when large-scale public savings are pooled under opaque schemes, regulatory oversights and clear laws are essential. The 1997 press releases, the CIS regulations were all part of a framework designed to protect ordinary investors. The legal journey from SEBI's 2002 order through diverging High Court orders and the Supreme Court's landmark decision were finally leading to a massive refund mechanism, and it shows the complexity involved when law, finance and real life all intersect. Even today, the refund exercise continues. Nearly 24 lakh claim applications have been settled and over 1,300 crores have been refunded. But the case remains a sobering reminder. Large-scale fundraising under the guise of land or real estate needs transparency, documentation, and regulation. So therefore, in conclusion, while the PACL proceedings have now been settled and the refunds are in full flow, there are a few key aspects which need to be revisited. The one major aspect which needs to be looked at is PACL's main argument before the courts, which was whether SEBI actually had jurisdiction to look into this scheme. PACL's claim is that they were running a land purchase scheme and it has nothing to do with the securities market. So why has SEBI come into the picture at all? This kind of a case highlights those regulatory grey zones which can be a focal point of a lot of litigation and a lot of dispute and a lot of turmoil in the securities market, which we have seen over the years, including this case which has now been running for more than 20 years. However, SEBI has taken some steps which has been introducing specialized regulations such as AIFs, REITs and InvITs, which are now looking after this aspect of the grey zone, where they are specifically regulating those aspects of these kind of schemes which fall under their jurisdiction. So, while these grey zones continue to exist, and we will see them coming into the picture more often than not in the future as well, once these kind of grey zones come out into the public, it is good to have these in open knowledge so that something can be done specifically about them. And we hope that in the future the markets become more secure and there are fewer and fewer grey zones in the securities regulation.